Our classroom stock portfolio of high-yield, dividend-paying companies now has an annual return of 31.09%, and it's beating the S&P 500 since the portfolio started. And our dividend-growth stock portfolio has an annual return of 20.41%. And our technology portfolio has the best return of all so far. And within that tech stock portfolio, if you only invest in the companies that pay dividends, your return would be even higher. And like in last week's video, later in the video, I'll discuss ways to potentially boost the return of our stock portfolios, but it will require giving up some portfolio diversification. We'll also talk about the stock we sold this week for a total return of 252.9%. This week, the S&P 500 finally broke its 6-week streak of positive weekly gains as it fell 0.96%. It's been an unusually good month of October, which historically does poorly during presidential election years. Next week is critical as we have many of the big hitters releasing their quarterly earnings reports, including Alphabet and McDonald's on Tuesday, Meta, Microsoft, and Lilly on Wednesday, and Apple, Amazon, Bristol-Myers, and Merck on Thursday. Then on Friday, we get the latest jobs report, which will go a long way to deciding if the Federal Reserve keeps lowering interest rates. So what is this slide showing? It's showing the portfolio value over time of our main portfolio, which invests almost exclusively in dividend growth stocks. As a class project in 2022, we started investing $12.50 each week into the portfolio, and it's now worth $2,536.69 after 147 weeks. Each week, we take that deposit and split it up to buy 10 different dividend-paying stocks, so we're buying fractional shares of stock. Each week, we re-rate the stocks, so the list of top stocks fluctuates from week to week, and it definitely changed a lot this week. And in August of last year, we started a second portfolio, this time investing in high-yield dividend-paying stocks. The tan line on the stock shows what the portfolio value would be if we instead put the money into a savings account. In our first year, 2022, stocks did not do well. As you can see, our portfolio had overall losses where the blue line falls below the tan savings account line. But the power of compounding is working in our favor as the portfolio really took off in November of 2023. I'll also update our tech stock portfolio later in the video, which has only existed since April of this year, but as I said, it's the best performing portfolio over that time, although with a lot of volatility. And for those that have been asking, I put the dividend growth stock portfolio and the high yield stock portfolio on our site, which is beatthestockmarket.com. More on that on the next slide. Hi, Professor Rex here. If you're new to my channel, I teach college accounting, and I often show my students how to use accounting concepts that I teach to pick stocks because it gets the attention of my students and keeps them engaged. To show them accounting concepts in action, starting in 2022, we started a class project in which on each Monday, I invest actual real-world money, which is $12.50 per week, which is roughly the equivalent of $50 a month, into 10 different dividend-paying stocks. And because those original students are no longer in my class, I decided to make this video series to let them know how our portfolio is going. Also, viewers can use our progress as inspiration for their savings goals and get ideas of company names that they can do their own research on. There are timestamp links in the description of the video in case you want to just jump to the list of stocks we bought this week, or the list of our best performers, or any other section of the video. In 2022, the year we started the dividend growth portfolio, the market did not perform well, but because I don't believe in trying to time the market, we kept buying each week at what turned out to be great prices. Then in 2023, stocks took off. Currently, the portfolio's value is over $2,536. The portfolio's return has been 20.41% per year. Last year, the portfolio's return was 28.6%, which beat the S&P 500, and in the preceding year, the portfolio once again beat the market. For those that have requested it, I've now put the dividend growth stock portfolio on my website, beatthestockmarket.com. And I've also put the high yield stock portfolio, as seen later in the video, on the website for subscribers. And because the high yield stock portfolio currently lacks any technology stocks, I've added to my site a list of technology-focused investments that provide income, with yields from less than 2%, like Microsoft, to yields as high as 10 to 12%, all of which I either currently invest in or have invested in. I'll also tell you which is my favorite. Of course, the technology-focused investments with the higher yields do not have the chance to grow their distribution yields as fast as one like Microsoft or Broadcom. There's always a trade-off. For those that can't afford a subscription, I'll continue doing these weekly videos on the weekend showing what I bought on the previous Monday. Subscribers will have real-time access to the list of stocks we buy each Monday, as well as real-time notifications when we sell a stock. Subscribers will also get a detailed report of portfolio holdings, and they will get access to the complete history of our trade confirmations. In this video, we talk a lot about our dividend growth portfolio and our newer high yield portfolio, which is geared more towards investors nearing retirement. The table at the bottom of this slide shows a portfolio comparison when both portfolios existed, because remember, they were started at different times. The high yield portfolio was started in August of 2023, and the annualized return so far is 31.09%, which is surprisingly higher than our dividend growth portfolio, which has an annualized return of 22.03% over the same time period. I would expect that the dividend growth portfolio would have the higher return over the long run, especially since the high yield portfolio has 0 tech stocks so far, but time will tell. If an investor was solely investing in the high yield portfolio, I would think about supplementing it with some tech stocks for additional diversification. And like I said on the website, beatthestockmarket.com, we've got some ideas of technology-focused investments. Now remember, the high yield portfolio has only existed for 14 months, so its annual return will likely jump up or down to a greater extent than our dividend growth portfolio's return. This slide shows a cumulative growth of the dividends we have received in our dividend growth stock portfolio. This is a fantastic visual of the power of compounding growth, and this is still very early in the portfolio's lifespan, if you will. Our dividends for the latest quarter increased 39% over the previous quarter, and our dividends for the latest quarter increased 130% over the same quarter a year ago. So you can see why people like to build a portfolio in which they can live off the dividends, because they grow so fast. The graph shows how quickly dividends are growing and is a great example of the power of compound growth. Albert Einstein is widely rumored to have called compound growth the most powerful force in the universe. So why do we only invest in dividend-paying stocks in our two main portfolios? The first reason we stick with dividend-paying stocks for our dividend strategies is, according to Hartford's study, over the past 50 years, dividend-paying stocks vastly outperform non-dividend-paying stocks. The total return for dividend-paying stocks has been 9.17% per year, but for non-dividend-paying stocks, the average return has been much lower at 4.27%. The study is updated each year, so go check out the source link that I included at the bottom of the screen. I'll also update it in our PowerPoint each year as it's updated. Morningstar also recently released a report that went all the way back to 1927 and came up with the same conclusion. Dividend-paying stocks have a higher return and less volatility than non-dividend-paying stocks. That second point about having less volatility is probably even more important than the fact that dividend-paying stocks have a higher return. So why is a lower amount of volatility so important? Well, it's much easier to stick with a less volatile investing strategy. The more volatile a strategy is, the more likely you are to panic and sell at the wrong time. So why are dividend-paying stocks less volatile? Because most dividend-paying companies are making a profit, which is why they have excess cash to pay back to investors. As you can see on the screen, risk and volatility of dividend-paying stocks as measured by beta and standard deviation tend to be much lower for dividend-paying stocks, and that's a good thing. And finally, the study also showed that the best performing stocks are dividend-paying stocks that increase their dividends, which is why our classroom dividend portfolios only invest in dividend-paying stocks that have increased their dividend recently. And BlackRock recently released a report showing that $10,000 invested in companies that either grow their dividends or initiate a dividend, which means they just start to pay a dividend, grew to $2.6 million versus $1.6 million for the S&P 500, a difference of 62.5%. That same $10,000 invested in non-dividend paying stocks only grew to $1.2 million. So stocks that raised their dividends or started paying a dividend beat the stocks that did not pay dividends by 116.7%. Now, the holy grail of dividend investing is to have a stock portfolio that produces two things. Number one, a growing stream of income that produces enough income to cover your expenses plus extra cash to cover travel, vacations, luxury purchases, etc. And two, also produces a growing stream of income that also grows faster than the rate of inflation. And dividend-paying stocks historically increase their dividends significantly higher than the rate of inflation. That means that quality dividend-paying stocks can provide a growing income stream for a lifetime. Now, this is in contrast to bonds, which do not raise their payments to bondholders. So here are two examples of stocks growing their dividend payouts over the years. The first is Broadcom. I bought Broadcom, a chip maker, in 2020, just 4 years ago, for my taxable account. At the time, its yield was 5.01%, meaning for every $100 I invested in the stock, I would receive $5.01 each and every year. The company has quickly grown the dividend to the point where the yield based on my original investment is now 8.21%. Of course, investors buying the stock now are not going to get that high of a yield because the stock's price has risen so much. That's why it's important to invest early and be patient. And I fully expect Broadcom to continue to increase its dividends well into the future. And if not, that's why we have constructed a very diversified portfolio. This is the power of investing in a quality dividend growth company. My second example of a high-quality company with a history of raising its dividends is good old Home Depot. In 2003, when I was attending college, I had started a dividend stock portfolio for the investment newsletter that I had started at the time. And Home Depot was recommended for that portfolio and is still in the portfolio today. At the time, its yield was a low 0.83%, meaning for every $100 I had invested in the stock, I would receive only 83 cents a year. Seemingly not much to get excited about. But over the years, Home Depot has grown the dividend to the point where the yield based on the original investment is now 31.1%. And, like Broadcom, while there are no guarantees, I fully expect Home Depot to continue to grow its dividend well into the future. Of course, investors buying the stock now are not going to get that high of a yield because the stock's price has risen. Again, this is why it's important to buy early and be patient. Now remember, stocks historically have a higher return than bonds and are also riskier than bonds, but you certainly will not find a bond that pays anywhere close to yields on the original investment that these two stocks are paying. And bonds don't increase their payouts to investors like stocks can and often do. Another reason to own dividend-paying stocks is for the potential to generate up to $123,250 of tax-free income each year if you are married and filing jointly. Remember, the ultimate goal of dividend investing is growing your portfolio to a point where it generates enough income each year to live off the dividends. And because companies historically increase their dividends above the rate of inflation, you have the ultimate income stream that not only covers your expenses but grows over time. And if you are married and filing jointly, you can make up to $123,250 in qualified dividend income and pay zero federal tax on those dividends if you have no other income. This is perfect for retirees. If you're single, that amount is $61,625. Those amounts often increase each year as the standard deduction increases and the tax brackets are adjusted. So how are these amounts calculated? First, you find the 0% tax bracket for long-term capital gain, and then find the standard deduction, which can be located in IRS Publication 505. As you can see, in 2024, the standard deduction increased, meaning you can potentially earn even more tax-free income from qualified dividends. Then the final step is to take the 0% capital gains amount and add it to the standard deduction, which means we get a final amount of $123,250 that a married couple filing jointly could generate an income from qualified dividends that would be federally tax-free. So why do we choose to start investing in our model stock portfolio with only $12.50 per week, which is essentially the same as $25 per paycheck? I personally am investing a lot more than that in these dividend strategies, but for our classroom model portfolios, the main reason we started with a low weekly investment amount is because I wanted to show my accounting students that you don't need much to build a diversified stock portfolio. In fact, when I was only making $11,000 per year as an enlisted member of the military, I started my investing journey with only $25 per paycheck. In other words, the equivalent of $12.50 per week. Because my current brokerage account, Fidelity, allows me to buy as little as $1 per stock, we can quickly and easily create a diversified stock portfolio with little money. Originally I invested $25 per paycheck, but found the process to be so fun that I split it up and now invest $12.50 every week. And we boost the contribution once per year by the amount of inflation to replicate the fact that people's paychecks usually increase at least by the amount of inflation. Another reason I started with a low investment amount was because one day I was wondering how much a young person, in this case a 17-year-old, needed to invest per week to accumulate $1 million at retirement. And it turns out it's only $11.74 per week. Of course, since most people's annual salary increases each year by the amount of inflation at the very least, I assume the contributions would increase by 3% each year, which is around the historical rate of inflation. That means in the second year, it's assumed that the person invested an additional 35 cents each week for a total of $12.09 per week instead of $11.74. For our Classroom Dividend-Growth stock portfolio, in year 2, we boosted the weekly investment 82 cents for a total of $13.32 per week because inflation was high that year. In year 3, inflation wasn't as high, so we boosted the weekly investment by only 49 cents for a total of $13.81 per week. Now, a very popular exchange-traded fund that only holds dividend stocks is called the Schwab U.S. Dividend Equity ETF, ticker symbol SCHD. SCHD is a large holding in my personal account, so I've been tracking SCHD's performance closely with our 2 dividend-paying stock portfolios. As of today, our dividend growth stock portfolio's annual return is 20.41%. If we had instead invested the same exact amounts into the ETF with the ticker symbol SCHD on the very same days, the portfolio's return would only be 11.6% per year, a difference of 8.81% per year. Our high yield portfolio is also outperforming SCHD, but by an even larger amount. Obviously, there's no guarantee that our portfolio will keep outperforming SCHD at such a high rate, but I've been gradually selling off my personal SCHD holdings and reinvesting in our 2 dividend-paying classroom stock portfolios, as well as the tech stock portfolio. I also prefer our actively managed classroom stock portfolio strategy rather than SCHD's purely algorithmic approach, where no one is overseeing the stock selection. It's just an algorithm. SCHD has at times had large positions in stocks that I consider to be value traps, and that's not a good thing. This slide shows our best performing stocks based on when they were initially purchased. This includes all 4 of our portfolios this week, but as you can see in the upper right, in the little table, the dividend growth stock portfolio was started much earlier than our other portfolios, which means the stocks in that portfolio have had much more time to see their prices rise. Therefore, this list of best performing stocks thus far will be dominated by our dividend growth stock portfolio, at least for the time being. For example, our tech stock portfolio is our best performing portfolio on an annual basis, but because it has only existed since April of this year, none of that portfolio's stocks have made this list yet. But I'm sure they will eventually. Stocks in yellow have been sold, for example, Evercore, F&G Annuities, and Repositrac. Our best performing stock so far has been Evercore. We sold Evercore last week for our dividend growth stock portfolio. The run-up in Evercore has been so great that it appears to be approaching overvalued territory, which is why I sold it. It provided us with a 252.9% return in a little over 2 years. That's a total return, which means it includes dividends. Broadcom, a chip maker, remains at number 2 with a 211.9% total return since its initial purchase. Both it and Evercore have total returns over 200%, which means the initial investment has tripled. So far, 2 stocks have tripled and 5 stocks have doubled their initial investment, with Repositrac barely missing that mark. The fastest risers that are still in our portfolios are NVIDIA in our technology-themed portfolio, with a total return of 194% in less than 10 months, and Bank of New York Mellon with an 84% increase in a little over 12 months. Bank of New York Mellon is on the list twice because it is in our dividend growth stock portfolio and our high yield stock portfolio, and it was bought at different times. And remember that total return includes both the dividends the company has paid as well as the increase in the stock price. This slide shows our best performing dividend stocks this week for our dividend growth portfolio. It does not include dividends for just that week. Despite the market falling this week, we still had a few good performers. They include Lam Research at 6.6%, Lithium Motors at 6.1%, West Pharmaceutical 5%, Raymond James, Kenvue, and Worthington Steel. This slide shows our best performing dividend stocks this week for our high yield stock portfolio, which has far fewer holdings than our dividend growth portfolio. So this week we saw Tapestry with 11.8% increase. Tapestry is formerly Coach, the company that makes expensive purses. So if you want to spend $10,000 on a Coach alligator purse, you can. I wouldn't do that, but if you want to, go ahead. You're going to be helping my stock price. And this slide shows our best performing technology stocks this week for our tech stock portfolio. The best performers were Lam Research again, 6.6%, NXP Semiconductors, and ServiceNow. Before we look at the 10 stocks we bought this week for our dividend growth portfolio, here are the dividend-paying stocks we bought a year ago, along with their total returns, which of course includes dividends. Stocks in yellow, like Tractor Supply, Lazard, Fidelity, National, etc., have been sold. On the left side of the screen are the 10 dividend growth stocks we bought about a year ago. Stocks in yellow, like I said, have been sold. American Express has been the best performer so far with an 86.7% total return in a year. The average return of the dividend growth stocks we bought a year ago is 42.36%, with Tractor Supply being held for less than a year. The annualized return is about the same, 44.28%. On the right side of the slide are the 8 purchases we made for our high yield stock portfolio. Now that portfolio utilizes 2 different strategies, and the strategies often overlap, meaning we often make 2 purchases of the same stock. The average return of the high yield stock purchases we bought a year ago is 35.32%, despite 4 of the purchases not being held a full year. The annualized return of the high yield purchases is 47.36%. Obviously, our purchases will not continue that high rate of return, but it's a great start for this younger portfolio. Here's a usual financial disclaimer. This presentation is for informational purposes only and is not a recommendation to buy or sell securities or engage in any investment activities. It's all well and fine to get investment ideas from others, but you always need to do your own research. Let's talk about the sales we made last week. The only sales we made last week were in the dividend growth stock portfolio. Last Monday, we sold one of the several investment banks that have done extremely well for us. In this case, Evercore. As mentioned earlier, it produced a 252.9% total return for the portfolio. The run-up in Evercore has been so great that it appears to be approaching overvalued territory, which is why I sold it. However, its dividend metrics are still exceptional, so I hope we're not selling too early. We also sold Elevance Health last Monday due to margin pressure in the health benefits segment. Formerly called Anthem, Elevance is the second largest health plan provider in the U.S. and has not performed well, giving us a 7% loss on average for the handful of purchases we made in Elevance. Now let's talk about the dividend growth stocks we bought last Monday. Here are my ratings for the top 15 dividend-paying stocks this past week, but remember we only buy the first 10 on the list that are not in yellow. The ones in yellow, in this case Microsoft, we don't buy more of because they consist or make up 4% or more of the portfolio. We try to keep the portfolio very diversified, so if a stock has grown to 10% of the portfolio, we don't invest in it anymore. Last week, we saw some of our favorite tech stocks back on the list, those being Applied Materials, Lam Research, and KLA-Tencor. All 3 of these companies make the equipment that is used to manufacture semiconductors. And of course, Microsoft is still on the list as it's probably the most diversified of all the tech stocks with its numerous different revenue sources. Remember, we use many criteria to filter stocks, and if they are hovering at a certain required level, they can make the list one week and then drop off the list based on a very small movement in that metric. Examples of criteria used to filter out stocks include required margin of safety and consensus earnings growth estimates over the next 12 months, which changes frequently. New to the list this week is BlackRock, which resides in the asset management sub-industry. It's one of my favorite stocks in the financial sector and has a quality rating of A+. It had previously been in the portfolio, but I sold it to raise some funds to invest in under-the-radar dividend payer, which was a company called WK Kellogg. Kellogg has provided us with a 56.5% total return on its initial investment so far. Remember, each week we buy 10 stocks, and since we're investing in such a small amount each week, it means we're buying fractional shares in our Fidelity brokerage account. And for those that have asked, we do not automatically reinvest dividends in the same stock from which the dividend was paid. Instead, each week when we are buying the 10 stocks as shown on this slide, we combine the weekly deposit with the dividends that have been paid that week and are sitting in the account as cash. We then take that combined total and split it amongst the 10 stocks that we're purchasing that week. And if we sold a stock, we, of course, use those proceeds too. In other words, we reinvest dividends weekly into the 10 stocks that we are purchasing that week. Now, for the sake of convenience, there's nothing wrong with simply turning on your broker's auto reinvest feature, but we think it's more ideal to reinvest in our top stocks each week instead of potentially reinvesting in a stock that is fairly valued as opposed to undervalued. This table on this slide includes the company's sub-industry, how undervalued they are according to our research, their risk rating, quality grade, and dividend yield. The most undervalued stocks last week appeared to be Applied Materials, Lam Research, HF Sinclair, KLA, Tencor, and Qualcomm. And as we saw earlier, Lam Research had a really nice gain this week. Remember, all these stocks pay a dividend and have recently increased their dividends, and our methodology used here indicates they're likely to continue to raise dividends. Therefore, this is a dividend growth strategy. And going back to Lam Research, since it had a really nice gain this week, I would assume that next week it will be further down on the list. The stocks with the highest yields were, last week, in order, Lyondell, Bristol Myers, HF Sinclair, PNC Financial, M&T Bank, and Merck. Oh, scratch that, M&T Bank did not make the list this week. Now remember, this dividend growth stock portfolio is in a brokerage account separate from my regular brokerage accounts to make tracking this portfolio easier. So in my other brokerage accounts, I'm also investing in these dividend growth stocks and the high yield stocks in the next few slides, and some of the tech stocks. This week I purchased over $3,000 of the stocks for myself. I'm also trying to tweak the buying strategy a bit to see if I can boost returns. I'll share the results with you once I have enough data. On this slide, I want to show the components to our quality grade. Quality-wise, we only invest in stocks rated B- or better for this portfolio for 90% of our purchases. The other 10% so far have been invested in smaller, under-the-radar companies that have recently started paying a dividend. These under-the-radar dividend-paying stocks tend to be riskier because they are smaller companies, but studies have shown they historically beat the market averages by a significant amount. We did not buy any under-the-radar dividend payers this week. All the stocks we bought this week qualify as high quality and are dividend growth stocks, which means they have a history of substantially raising the dividends that they pay to their shareholders. Risk is the first quality component, which we mentioned on the previous slide. The next quality component is competitive advantage. Obviously, the more competitive advantages a company has, the better investment candidate they are. The next quality component attempts to evaluate companies' management. Our evaluation includes both management's use of capital and general decision making, but also our research dives deep into accounting data to look for red flags in the company's accounting practices, as well as the quality or reliability of their reported profits. And finally, the last quality component is financial health. If you're looking for lower risk stocks, I would suggest looking at Microsoft, West Pharmaceuticals, Yum Brands, Nike, and Huntington Ingalls. Remember that the risk rating is comparing these stocks to other stocks, not to other investments like bonds or CDs. The companies earning the highest financial health ratings are Applied Materials, Lam Research, Microsoft, West Pharmaceuticals, and good old BlackRock. Now let's look at the company's dividend growth grades. Remember, historically, the best performing stocks are those that both pay a dividend and have grown their dividend recently. As you can see under the grade called Grade for Recent Dividend Growth and Current Yield, the stocks with the best combination of dividend growth and a higher yield are Applied Materials, Lam Research, Bristol Myers, HF Sinclair, PNC Financial, and Lyondell. All of these earned an A- or better grade. Ideally, you want a higher dividend, high recent dividend growth, and the best potential for future dividend growth, but that's not the way it works. Companies that are already paying out higher dividends rarely have the greatest potential for the greatest growth in those dividends. In our list, as you can see from the last grade called Dividend Growth Potential, the companies in the best position to increase their dividends substantially are Applied Materials, Lam Research, Bristol Myers, Microsoft, West Pharmaceuticals, and KLA Tencor. These earned a B or better grade. The companies with the best combination of recent dividend increases and potential of future dividend increases are Applied Materials, Lam Research, Bristol Myers, and Microsoft. Here are trade confirmations from last Monday for the dividend growth stock portfolio. As you see, we sold Evercore and Elevance. We took the weekly deposit plus any dividends we had recently from all the companies in the portfolio, and we took the proceeds from our 2 sales and then invested them in the top 10 stocks on our buy list for the week, as long as those stocks did not make up 4% or more of the portfolio. Now let's talk about ways to potentially increase the return of our dividend growth portfolio. For those that are okay with giving up some portfolio diversification, I believe there are 4 potential ways to boost the portfolio's returns. Each week, we buy 10 different dividend-paying stocks ranked 1 through 10. On average, the stocks ranked 1 through 5 outperform the stocks in the positions ranked 6 through 10. Therefore, the first way to potentially boost portfolio returns is to buy only the stocks positioned from 1 through 5. However, the downside is this obviously reduces portfolio diversification, but some investors are comfortable with a more concentrated portfolio. Option number 2, don't limit individual portfolio holdings to 4% of the portfolio's total value. Normally, if a stock's allocation of the portfolio is 4% or greater, like Microsoft last week, I won't purchase more of that stock. This technique reduces the portfolio's risk by ensuring the portfolio doesn't become heavily weighted in 1 or 2 stocks. I purposely created this portfolio so it would be very diversified because the ultimate goal of dividend investing is to have the dividends cover all your expenses plus generate extra income for vacations, travel, etc. Now, I'm a conservative investor and I'm personally investing a lot in these dividend portfolios. So I want to make sure the portfolio is not only well diversified between sectors, but also between industries and even sub-industries. That way, when the inevitable dividend cut happens, it doesn't affect one's cash flow in a major way. However, an investor who has a higher risk tolerance and therefore doesn't mind a more concentrated portfolio might try removing the 4% limit in an attempt to boost the portfolio's returns, especially if the company is in the top 5 of that week's ranking, as mentioned in bullet point number 1. Number 3, the under-the-radar dividend payers, despite having some incredible performers like F&G Annuities' 119% gain in 12 months, and ReposiTrack's 97% gain in the same time frame, on average, they have not performed quite as well as the dividend-growers in the portfolio. So skipping the under-the-radar dividend payers is an option to try to boost portfolio returns. One possible reason these under-the-radar dividend payers have not done quite as well as the dividend-growers is because many of the under-the-radar stocks are very small companies, and small stocks have not performed as well in recent years. Like the previous strategies, this method reduces portfolio diversification. And number 4, sell a stock when it is fairly valued, even if the dividend and quality metrics are excellent. Now, we don't sell often in the portfolio and tend to only sell if the company cuts the dividend or the stock appears to be overvalued or the company's dividend quality metrics fall out of the top 50% of companies. In other words, if a stock appears to be fairly valued but the dividend and quality metrics are still good, we usually will not sell the stock just because it's fairly valued. But if you have your own valuation methodology and it signals the stock is fairly valued or even overvalued, you might try selling at that time and reinvesting that week's 10 stocks that we are buying. The downside would be higher turnover, but this could boost your portfolio's return by not holding on to fairly valued stocks. If you try this, I'd be very interested to hear your results. Of course, this 4th strategy is the most difficult to implement because you have to implement your own valuation methodology. For those looking for a less hands-on approach, let's talk about a couple options to potentially simplify things. For model portfolios, we invest weekly, but there's no hard and set rule that says to do that. Most people invest with every paycheck, meaning that most people have funds taken out of their paycheck, which is usually every other week, and it's automatically invested in their 401k. When I started our Dividend-Growth stock portfolio, I originally invested $25 every other week instead of $12.50 every week. I only switched from every other week to weekly because I found the process to be fun. The advantage of investing every week, as opposed to every other week or monthly, is you get more diversification. So if one doesn't mind less diversification in the portfolio, option 1 is to invest every other week or even monthly instead of weekly. Option 2 is to just buy the high quality stocks, meaning those with a quality rating of B- or better, and hold forever. Over time, some will turn out to be clunkers, but they will just become very small parts of your portfolio as you let your winners run. On this slide, we're looking at the stocks that have raised their dividends recently, stocks in our portfolios, that is. The holy grail of investing, as we mentioned earlier, is to have a portfolio generate enough dividends to cover your annual expenses, a level I've reached despite being on a teacher's salary. Historically, dividend-paying companies raise their dividends by 5 to 6% per year, which is above the historical rate of inflation. As you can see, ours are raising by about 10%. This means a stock portfolio can produce the ultimate passive income stream, that being one that increases each year above the rate of inflation. We should start seeing even more dividend increases as many companies start announcing their third quarter results over the next month and a half. And this week, West Pharmaceuticals, recent addition to our portfolio, raised its dividend 5%, and Starbucks boosted theirs by 7%. The last 22 dividend increases for the portfolio have an average boost of 10%. This slide shows the stocks in our portfolios that have chosen to split their stocks. Since we keep track of every individual purchase in Excel, it's important that we have this slide to remind us to go back and adjust the purchase price, shares held, and dividends per share that we receive once the stock split has occurred. Here's a look at the 10 stocks that make up the largest portion of the dividend growth portfolio as of Friday after the market closed. Currently, 4 stocks comprise 4% or more of the portfolio, with Microsoft moving up to the top spot. Remember, our goal is to build a conservative and diversified portfolio by limiting the amount we invest into one single company. Aggressive investors might not want to limit the investment in any one stock. But I'm a conservative investor, therefore we temporarily stop investing in a company if they make up more than 4% of our portfolio. This leads to a less risky, more diversified portfolio. It's true that our portfolio's return would likely be higher if we always invest in our top 10 stocks, regardless of the size of the stock's portfolio allocation. But that also creates a more concentrated, more volatile portfolio, and many investors cannot psychologically stick with a volatile portfolio. Volatility often causes investors to panic and sell at the worst time. Our portfolio holdings now are at 100. That might seem like a large number of companies to keep track of, but the spreadsheet we have developed for tracking the companies makes it obvious when to sell a company. Once we download company financial accounting information into the spreadsheet, which we do at least weekly and doesn't take that much time. The thing that did take a lot of time was creating that spreadsheet. It took over 2 years of hard work. Now, of course, our other portfolios have far fewer holdings. And let's talk about another portfolio. Let's talk about our high-yield dividend-paying stock portfolio. I've had several older students who are closer to retirement take my classes. They are more interested in stocks with higher dividend yields because they want to live off those dividends, and asked to start a portfolio using a strategy featuring stocks with higher yields than the stocks in our dividend growth portfolio. So in August of 2023, we started investing $12.50 each week into stocks with higher dividend payouts. The portfolio as a whole has had an annual return of 31.09% so far. Since the portfolio has been in existence for only 14 months, that return will likely fluctuate a lot more than the return of our dividend growth stock portfolio, which has existed for about 2 3/4 years. Currently, the high yield portfolio's dividend yield, if you bought everything today, is 4.22%. But the companies in it likely will not grow their dividends as much as the stocks in our dividend growth stock portfolio. Therefore, this portfolio would be more geared toward investors closer to retirement. Having said that, many stocks in the portfolio have increased their dividends. Plus, we've sold some stocks and then reinvested the extra cash into more high-yield stocks. And that has pushed the portfolio's yield based on the amount we invested to 5.02%. 2 strategies are being implemented in this portfolio, as you'll see in the next few slides. Strategy 1 emphasizes a high dividend yield over dividend growth. Strategy 2 also features stocks paying higher dividend yields, but places a bit more emphasis on recent dividend growth than Strategy 1 in an attempt to try to get the best of both worlds, both high yield and dividend growth. Strategy 2 has been the better performer so far. The average investment in Strategy 2 has provided a total return of 18.31% and has been held for an average of 181.6 days so far, which is an annualized return of 40.22% using Excel's rate function. Now, it's not likely that portfolio could keep up an annual return that high since stocks historically average 9 to 10% each year. And remember, it doesn't include any tech stocks so far. On this slide, we're looking at the high-yield dividend-paying stocks we bought last week. And because the high-yield stock portfolio currently lacks any technology stocks, for those that want to add diversification to this portfolio, I added to my site a list of technology-focused investments that provide income with yields from less than 2%, like Microsoft, to yields as high as 10 to 12%, all of which I either currently invest in or have invested in. I'll also tell you which is my favorite. Of course, the technology-focused investments with the higher yields do not have the chance to grow their distribution yields as fast as one like Microsoft or Broadcom. There's always a trade-off. Don't chase yields. One thing that's different about this higher yield strategy versus our dividend growth strategy on the previous slides is we only purchase 8 stocks. And as mentioned earlier, we have 2 different strategies within this portfolio. Strategy 1 still emphasizes high dividend yield, but places a bit more emphasis on recent dividend growth in an attempt to try to get the best of both worlds. Because there are 2 different strategies, we have 4 stocks in strategy 1 and 4 stocks in strategy 2, giving us 2 rankings. So each week we take $12.50 and split it between the 8 stocks. So each stock gets a 1/8 weighting. Having 2 strategies within one portfolio also means that a stock could appear in both strategy 1 and strategy 2, like Bristol-Myers Squibb does. If that's the case, instead of the stock getting a 1/8 weighting, they get 2/8, which is 1/4, which means it gets 25% of that week's investment. Both strategies still only invest in high quality stocks, meaning a quality rating of B- or better. The 4 high yield stocks we bought this week while implementing strategy 1 are Bristol-Myers, HF Sinclair, Pfizer, and CVS Health. And the 4 high yield stocks we bought this week while implementing strategy 2 are Bristol-Myers, HF Sinclair, PNC Financial, and Lyondell. This week's purchases have average yield of 4.7%, with Lyondell coming in the highest with a 5.9% dividend yield. And here's a look at Monday's ratings for competitive advantages, management, and financial health. On this slide, we can see Monday's grade for recent dividend growth and current yield, as well as recent dividend growth history. And the last column, you can see their grades for dividend growth potential, which will be much lower than the stocks in our dividend growth portfolio, which consist of stocks with usually lower yields, but a greater potential for excellent future growth in those dividend yields. Here are our trade confirmations from last Monday for the high yield stock portfolio. We took the weekly deposit, which I had to double this week because I recently missed a deposit, plus any dividends that had recently been received, and then invested them in the top 8 stocks on our buy list for the week. Now let's talk about our 2 technology stock portfolios. Because my students love technology stocks as well as crypto and options, we started 2 technology portfolios just for fun. For the first one, on January 1st of this year, I funded a Fidelity account with $1,000, and we invested it into only stocks offering products or services involved with certain technology themes. Unlike our other portfolios, we are not investing additional funds each week into this portfolio. We're sticking with the original $1,000 investment. The tech themes we built the portfolio around so far are artificial intelligence, cloud computing, software as a service, cybersecurity, and big data. This portfolio can invest in stocks outside of the technology sector as long as the company is connected to one or more of our tech themes. For example, both Meta platforms and Google are in the portfolio but are both in the communication sector. They are not in the technology sector. So far, the portfolio has increased 29.9% in a little over 9.5 months. In comparison, technology ETF with the ticker symbol XLK is up 20.6% over the same period. Best performers so far are NVIDIA Corporation, 194%, Meta Platforms, 67%, Broadcom, 60.7%, SAP, Pure Storage, ServiceNow, and Fortinet. Now, back in late April, we started a portfolio that only invests in stocks that are officially in the technology sector. Like the other portfolios, we invest $12.50 each week into it, and then boost that investment annually by the rate of inflation. I hesitate to call this a portfolio since it's limited to only one sector, but so far it's been fun to follow, and it has the highest performance. Since this portfolio has started, it's outperformed the 2 dividend portfolios over the same time period, but that's a short time since it was only started on April 29th of this year, and its volatility has been pretty high. So how is this portfolio different from the $1,000 tech portfolio shown on the previous slide? The portfolio on the previous slide is based on certain technology themes and therefore includes some stocks that are not technically in the technology sector, like Google and Amazon. So on this slide, I rate the top stocks for the week, but they must be in the technology sector. The average investment so far has been held for 89.5 days and has produced a total return of 8.1%. Using Excel's rate function, that's a 37.41% annualized return. If we instead invested our weekly investment into XLK, instead of an 8.1% average, would get an average return of 5.28% over the same time period. And if you only bought the companies that pay a dividend within this portfolio, the annualized return would be even higher, coming in at 44.85%. Note that all these stocks are high quality, meaning they must have a quality ranking of B- or better. Also note that the ranking system used for these tech stocks may differ from the rankings we use to rate dividend-growth stocks, because many stocks do not pay dividends. Therefore, in this ranking, we ignore the criteria that involves dividend growth, dividend payout ratio, etc. But we use the valuation methodology we discuss in class that can be used on all large stocks, whether they pay a dividend or not. The 4 top tech stocks on our list last week were Lam Research, Applied Material, Adobe Systems, and good old Microsoft. So in the comments, let me know if you have any questions, and also let me know what other kind of investing videos you'd like to see. And finally, here are the places you can reach me: YouTube, obviously, as well as my website, beatsthestockmarket.com, LinkedIn, and Twitter. Remember, you can now find both the dividend growth stock portfolio and the high yield stock portfolio on beatthestockmarket.com with real-time transaction data on Mondays when we make our weekly investments and anytime we sell a stock, as well as information about our portfolio holdings. I'll see you again next weekend with a list of stocks we will have purchased on Monday. See ya.